Hey guys, welcome to this video. Today we're going to continue on the fundamentals of the stock market. We talked about doji patterns, we talked about trends, and now we're finally going to get into chart patterns. So what are chart patterns? Well, essentially they are patterns of the chart that predicts whether if there is a continuation in the price or whether if there is a potential price reversal. So how does these things work? How can such predictions be made? Well, in technical analysis, it is based on historical trends, historical data. And the whole basis of technical analysis is that history tends to repeat itself. So we'll talk about some of the patterns that are widely adopted by professional traders and how they use these chart patterns to determine what the price is going to do. There's also too much information in trading. So my goal is to provide a concise version of these information so that you are using the ones that are widely adopted and so you can also understand what's the general market behavior. There's too much information, so you don't really want to focus on the niche areas that no one is going to look at. Alright, so let's jump right into it. We're going to first talk about head and shoulders, which is one of the patterns over here. Right, so when we talk about patterns, it is basically trends, but then it forms some kind of pattern over time, and this occurs many times throughout the history, which indicates how the price may potentially go. So what is head and shoulders? It is one of the most used chart patterns actually, and this is represented by three peaks. As you can see, the two outer peaks are actually shorter than the middle peak, and they're called the shoulders, and the middle one is called the head, right? So this actually have another portion which as you can see, we talked about this in trends, right? So this line over here, which supports the price and kind of protects it from going down further several times, this is called a support. And in this case, for head and shoulders, they have another nickname called the neckline, right? The neck below the shoulders. You don't have to remember the name, honestly, again. But if you aren't familiar with trend lines, please look at one of the previous videos for more information. So what does this chart actually show? Well, it shows that the price tries to go up once, right? Dips back down, goes up again, and actually forms a higher high, which is great. But in this case, it falls back down below, and when the demand tries to push the price up further, it wasn't able to push it above the previous peak. So the price actually drops, right? So in this case, the theory for head and shoulders is that after the second shoulder, right? So the prediction comes after the second shoulder forms, which dips back down. If the price actually drops this support, which is called the neckline again, then it is really it is an indicator, and it means that it's more likely the price will dip further. So why is the case? Why is the price supposed to go down? Well, in this case, you can argue that it's because the demand was not as aggressive the second time, and it shows that there is a lack of buyer compared to the previous time, meaning that there is more supply pushing the price back down again. And because of this, it means that the sellers are slowly winning, right? But you can also argue that because so many people believe in technical analysis such as chart patterns, and head and shoulders is one of them that proved to be relatively accurate in many of the historical charts, where if a head and shoulder pattern forms, then it's likely that the price will continue to go down. And because people believe in them, people look for them, and then when the pattern forms, the sellers would come in and sell at this break point after it breaks, right? So it's a little bit of a self-fulfilling prophecy, but we have to understand that the price is not determined by news, right? We talked about this previously. The price is determined by the orders that people send in. So if majority of the public sending orders because they look at this chart believing that it will go down, then it will go down. All right. So again, head and shoulder is one of those ones that it might not make too much sense at the beginning, but it is a little bit more on the psychological side as well because so many people are looking at it. But it is definitely one of those highly adopted patterns that many traders look for. Right, let's move on to the next one. And this one is called a double top. And then we'll talk about multi-top as well. But essentially they show similar stories, right? So double top is represented by upward momentum in price. It hits the top, right? And then dips back down. And then it tries to break up again. However, it wasn't able to break the resistance, and in this case, it goes back down again, right? Hence, showing two tops. We talked about resistance previously as well. So what does this chart mean? Well, it means that there are two chances, and twice these buyers are trying to break this point, right? They try to break this point by putting in more demand. However, there is a huge seller at this point, or there's a lot of sellers that's very strong at these significant resistance, meaning that people are putting in orders to sell their stocks, and because of that, they weren't able to actually push the price further up, and it happened twice. And this generally means that the price will actually break down as well. Because the resistance was hit and there is a strong seller at this region, it means that it is likely that the price will not be able to break this point, and because it falls back down, then it's likely to fall back further if it breaks this point. So what do you want to do, right? What do you want to do if you're trading? Well, if you are buying, of course, you don't want to buy at these resistance point, right? Sure, if it breaks the resistance, that's a good news. However, if you're a seller in this case, you probably want to put in your orders to sell just slightly below this resistance, right? So let's say if you bought the stock earlier, right? It goes up, comes back down, and then it goes back up again and it starts dropping. Then you probably want to sell your stock because it's most likely that it will not break this point. Or maybe you saw it hitting this resistance before, so you know that it's likely that it's not going to break this resistance again. Then you probably want to put your order ahead of time, right? On a side note, I do want to emphasize that chart patterns tend to be stronger on shorter time frames. Meaning that if you're looking at a chart on hourly or even minutes, then they are much stronger than when you're looking at it from a daily standpoint. I'm not saying that it's not relevant on a daily standpoint, but what I mean by that is imagine if it's on hourly or a minute time frame, that means it's within the day, right? If there is a resistance, meaning that there are sellers looking at this point to sell, do you think they will still be there maybe an hour later? Well, most likely, right? Because it's within the same day. However, if it's within across like a few months, let's say between January and May, it hit the resistance twice. Is it likely that the next time it hits the resistance, the seller is still going to be there? Well, could be, but less likely, right? So that's why it is more likely that when you see these chart patterns, they hold true. There's a probability for them to hold true on a shorter time frame. Okay. Let's talk about multiple tops, and honestly this is pretty much the same as double top, except the fact that it hits the top multiple times, right? And because it hits the top multiple times, it means the resistance is even stronger, right? It couldn't break it the first time, couldn't break it the second time, couldn't break it the third time, then most likely it will not be able to break it. It doesn't mean that it won't, right? Eventually, perhaps there's a chance that it will, but it is more likely that it will go down rather than for it to go up. Cool. Let's continue and end this session with double bottom and multi-bottom, right? This again essentially tells the same story as double top, except in the opposite direction, right? So instead of a resistance, it will be a support at the bottom. And because there is a support and it was able to support the price point multiple times, it's likely the price will go back up. In many of these charts that I have shown, you can argue that there is both a multi-top and a multi-bottom, right? You can see there's a top and then there is a bottom. And that is true, right? And we actually touched on this topic previously in trends, which is what we learn as a channel. A channel forms when there is a fluctuation between the support and the resistance. So you may ask, should I sell or should I buy in this case? Because I see both a resistance and a support. Well, you can do either, right? And honestly, some people prefer to buy, some people prefer to short stocks. And you can do either, you can do both. Preferably, you probably do one if you're trading on a shorter time frame, just so you don't confuse yourself. But if you're more into the game and you're more confident, then perhaps you can do both. So just as long as you are not buying at the resistance and you're not selling at the support, right? That will be the opposite of what you want to do. But besides that, you can do either. So we talked about quite a few patterns, but there's three main ones, right? In summary, we talked about head and shoulders. We talked about double top, multi-top, as well as the last one, we talked about the double bottom and multi-bottom. There's a few more like triangles and wedges that we're gonna touch on, but I hope you enjoyed this content and you find these charts actually useful. If you do enjoy the video, please support the channel and like and subscribe. Thank you. Until next time.